Hello and welcome to the Golden Thumb Rule. My name is Kshitij Anand, and in the Golden Thumb Rule, we break down timeless investing principles with market experts and decode what really works in wealth creation. Now, today's conversation is especially relevant for investors navigating volatile markets and looking beyond large caps for higher growth opportunities. Now, we are diving into the fascinating and often misunderstood world of small cap investing. Small caps have, in fact, historically been the biggest wealth creators in the market, but they're also the most volatile. Now, to help us decode these questions and uncover the golden rules of small cap investing, we have with us Aniruddha Naha, who's a CIO alternates at PGIM India, who brings a deep experience in identifying opportunities beyond the obvious. Aniruddha, great to have you with us. How are you, sir?
Thank you. Thank you, Kshitij, for this opportunity. Doing absolutely fine. I think very exciting times, as you mentioned, and looking forward to this conversation.
Market history, shows that small caps often deliver their strongest returns after a phase of sharp correction, not during periods of euphoria. Now, is it the best time to invest in small caps when they are outperforming or when they are deeply underperforming?
It's a very interesting question. Actually, it talks about the full cycle in terms of how small caps do over a period of cycle. Generally, our sense and our the way we look at small cap investing, and for that sake, generally investing, we
Sure.
like to look at a segment of the market when it is beaten down.
Mm,
It offers opportunity. We would be extremely gung-ho when markets beat down small caps. I
mm,
think the best time to build into a small cap portfolio, a small cap segment of the market, is to buy them when things are reasonably bad, sentiments are bad,
right.
but you have got at least the outlook for earnings looks good enough. We've always said it's a two component part of it. There has to be an earnings growth and there has to be a chance of a PE re-rating.
Okay.
At the bottom of a curve, a
Mm.
cycle, small caps, for that sake, give you both these legs probably if selected properly.
Absolutely. And another under-researched and under-owned companies often, they are pricing inefficiencies, enabling investors to benefit from discovery-led re-rating. So what makes small caps a fertile ground for alpha generations compared to the large caps?
See, if you look at it, large caps are probably 100 odd names. Okay.
Sure.
The mid caps are 150 as defined by the regulator.
Hmm, hmm,
Small caps start from the 251st company, and there is no end to the tail. Hence, the number of businesses itself, we go down to the 4,000th company by market cap, let's say.
hmm,
So
hmm,
the what of a basket of about 3,700 odd companies to choose from. So, and in a falling market, when sentiments are negative,
hmm,
invariably that is where the opportunity will be because there will be businesses which will be overlooked,
hmm,
it will markets driven by sentiments, and that's where probably the creation of alpha over a period of time.
hmm,
Okay. And frankly, when you're looking at alpha in a small cap, you'll have to take a little longer periods of time for to trying to understand how it plays out. But we are extremely comfortable and we believe that these are very under researched. So alpha generation over a period of time, we've looked at
right.
it over periods of 5, 10, 20 years since 2008 also.
Hmm,
If you
hmm,
include the 2008 the fall also,
right.
the highest amount of alpha that has been generated has been in the small cap
In
space.
fact, short-term flows really reward small cap investors, but time in the market and not timing unlocks the compounding potential. So, can small cap investing work without a multi-year investment horizon as well?
So, to put it short, it's very difficult. I'll tell you.
Mm.
See, these are businesses. Generally, the biggest wealth that I have seen getting created is when a small or a micro cap, graduates from a small cap to a mid cap, and then over a period of time from a mid cap to a large cap.
Right,
Okay,
right.
that is where you see earnings, scale, and a PE re-rating happens.
Yes.
Now, these don't happen in short periods of time. Okay. Some of the best known NBFCs today in India were
Mm,
all small caps at some point of time in the 2000 to 2010 decade. So
mm,
our sense is small cap investing, if you got the businesses right,
mm,
you could hold them for a decade also. And that is where you will have to live through
mm,
patiently cycles. Invariably, in a 4 5 year period, these businesses will go through their own cycles. In
mm,
a down cycle, these businesses will see a 20 30% drop. Okay.
mm,
But if you can hold them through and your conviction in terms of how the scalability of the business plays through, in
mm.
the conviction of backing the right promoter and
Right.
the scope of opportunity, I think the biggest money is when you buy into small caps and forget them for a period of time.
Yes, you
What do you
answered
think?
it correctly. That staying with your stocks is something which will actually create more wealth for investors. Sustainable wealth creation comes from focusing on earnings, durability, capital allocation, and governance, and not just price trades.
Right.
Should small cap investing be driven by, let's say, narratives and momentum, or by fundamentals?
Our sense is through and throughout a cycle, it's the fundamentals which matter. So, in terms of fundamentals, other than what you mentioned, which are very important, capital allocation, what has been the history of governance, okay,
Mm,
how clean has been the balance sheet, what is the kind of investments that have gone into the business, etc. There's another thing that we also start off with actually is the
mm,
fact that what is the kind of cash flow generation. And by cash flow, we focus on operating cash flows in setting the boundaries within which you invest. See, in a bull market, unfortunately, what happens is you miss out on a lot of ideas,
mm,
and there is a sense of repentance, which then invariably leads to greed. And if you've gone ahead and built a good portfolio at the bottom of a cycle, like the one which we are in today, probably,
mm,
okay, our sense is there will be ideas you will not be able to capture all of them. But if you stick to the businesses that you have picked based on fundamentals,
mm.
and if you give it the cycle timeline that you asked me about, over a period of time, they
Sure.
invariably go ahead and beat not only inflation, they create alpha over inflation.
Absolutely. And, balance is definitely a key, and conviction led bets combined with diversification across business models help manage downside while capturing the alpha. Is concentration or diversification the better approach in small cap investing?
There is actually, frankly, to put it, there is nothing called a better way of doing it.
Sure.
The only thing is your own comfort levels.
Yeah.
So I have seen funds or portfolios doing exceedingly well with
Uh,
15 stocks, and then
right.
portfolios doing exceedingly well with 45 stocks.
Okay.
Okay, if he or she or the person is comfortable enough building a portfolio and is extremely convinced about the 15 odd businesses in that portfolio,
Hmm.
they don't need to actually go ahead and diversify. That
Exactly.
sense
Right.
of diversification actually creates dilution.
Hmm. Hmm.
But given the segment, especially here, it
Hmm.
is, and such a large universe, just to play it safe with even 30, 35 names or 40 names, let's
Right.
say, is a good enough strategy to create alpha over the other segments of the market.
Small caps have sort of higher operating leverage, which amplifies both downturns and recoveries, so making them cycle accelerators. So, why do small cap typically sort of underperforms at the end of a cycle, but sort of outperform at the beginning of a new one?
It is all dependent on earnings.
Okay.
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 Now, usually when they are small,
Hmm.
uh, they start off their business as cyclical businesses. And then
Right.
as the strength grows in these businesses, you start seeing structural strength coming through these businesses, and that carries them from being a small cap to a mid cap, and
Hmm.
then over a period of time. So our sense is this cyclicality is in a large part of the universe. I won't brush all of them together. There
Hmm.
is a decent amount of cyclicality which hits these small caps and how vulnerable they are to this
Hmm.
cyclicality. If they have got, fortunately today, I think India, the small cap segment is blessed because of the cleanliness of balance sheet. But
Uh-huh.
our sense is it is all dependent on how earnings play out.
Sure.
Okay. If the earnings play out, yes, and this is what we are living through, frankly speaking.
Hmm.
Into the next 2 years, if I look at earnings from Bloomberg, the
Hmm.
highest earnings CAGR over the next 2 years is the small cap segment.
Okay.
And that is the segment which has seen the biggest drawdown.
Uh,
So our sense is we are not too bothered about whether they're accelerators at the top or bottom.
right.
Our sense is if they're good businesses
Right.
giving you visibility of earnings over the next 2 to 3 years
Sure.
and the kind of valuations where they have come down to,
Hmm.
we would be extremely excited building into portfolios around these times.
Anything you would like to add? So, what role does sort of earnings growth play in driving small cap outperformance?
Generally, people are enamored by the price. Okay,
Sure.
and that's where momentum or fear comes in.
Yeah.
As analysts, fund managers, I think so. What we do is we focus on earnings.
Earnings, yes.
More so, if you ask us, if we have to be a little more nuanced, we focus on cash flows. Just purely drawing down from Bloomberg, the earnings estimate, when we look at it for, let's say, the Nifty over the next 2 years, is anywhere between 14 to 16%.
Yeah, right.
For the mid cap, it is on the higher teens.
Yeah.
But when you go into the small cap over the
Mm,
next 2 years, we clearly see that the earnings estimate over the next 2 years is
mm,
going to be beyond 20%. It
right.
could be anywhere between 20 to 22, 20, 22 to 24% kind of earnings growth. So our sense is earnings is extremely important. And the strength of earnings is already reflected in the small caps today as we speak. It is not that we are just trying to judge something into the future.
And is small cap investing inherently risky, or poor selection is the rare risk? Should investors sort of buy small caps when they look the strongest or when they feel the weakest?
See, the risk in a company is the biggest risk is the company mortality of the company or the death of a company.
Right.
Okay, that's the biggest risk. If that is taken care of, I
Mm,
think so businesses evolve in India, okay,
mm,
over a period of time. So what we need to be extremely careful from a risk perspective is whether the businesses will survive or not. Now,
right.
survival of businesses very, very clearly, it's very easily visible. You look back into the history of how cash flow generation has been and
Yes.
how clean the balance sheet is.
Mm,
Once these two things are taken care of, along with a good set of promoters,
mm,
I think that takes care of the safety factor or the risk factor. The rest, frankly, the risk is not exactly risk, it's volatility.
okay.
Okay. So people who are especially investing in the small cap segment, they must be mentally prepared for volatility.
Absolutely. Well, on that note, thank you so much for taking the time out, Aniruddha. And in fact, powerful insights there. Discipline, patience, and fundamentals clearly stand out as the pillar of small cap investing. Well, on that note, thank you so much, Aniruddha, for joining us today on the
Thank
Golden.
you for this. Thank you for this opportunity.